In what other industry does someone with no college degree, no formal training, and no connections outperform someone with the best education and the most powerful network in the world? Meet Ronald Read. For most of his life, Ronald wasn't anyone special, at least not on paper. He pumped gas. He swept floors as a janitor. He didn't even own a car for most of his life. He hitchhiked to work and to high school for years. Nobody would have picked him out of a crowd and guessed he was destined for wealth. But when Ronald Read died, he left behind a fortune of more than $8 million. He didn't win the lottery. He didn't inherit it. He built it, one paycheck at a time, by living far below his means and quietly buying shares in solid, boring, blue-chip companies. Then doing almost nothing for decades. Now, meet Richard. Richard went to Harvard. He built a glittering career as an executive at Merrill Lynch, one of the most prestigious names on Wall Street. He retired in his 40s into a mansion, by every measure society uses to judge financial intelligence, the clear winner over a man like Ronald. Then, 2008 happened, and Richard, the Harvard-educated, Wall Street-trained financial genius, went completely bankrupt. He lost the mansion. He lost almost everything. So how does a janitor end up outperforming a Wall Street executive? It isn't luck, and it isn't some hidden stock tip nobody else had access to. Ronald Read owned shares that any of us could have bought. He read the same newspapers, had access to the same banks, and lived in the same country as everyone else chasing the American dream. The only real difference between him and almost everyone else wasn't information. It was behavior. Because building wealth isn't really a hard science. It isn't physics where the same input always produces the same output. It's a soft skill, closer to psychology than mathematics, where how you behave with money matters far more than what you know about it. A brilliant person who loses control of their emotions can destroy a fortune. An ordinary person with zero financial education can build one if they master just a handful of behaviors. This is the story of why intelligence isn't enough, and what actually separates people who get rich from people who stay rich. So why doesn't intelligence guarantee investing success? To answer that, we need to look at what the finance industry has actually optimized for over the last 2 decades, and it isn't quite what you'd expect. Wall Street has recruited some of the sharpest minds on the planet. Physicists who could have worked in aerospace. Mathematicians who could have taught at the best universities in the world. Engineers building models so complex that most of their own colleagues can't fully explain them. You'd expect this flood of raw intelligence to have produced a golden age of investing, where returns are more predictable. Panics are rarer, and ordinary people finally get access to expert-level results. It hasn't happened. There is no strong evidence that markets, on average, have become easier to navigate, or that professional investors as a group have pulled meaningfully ahead of amateurs who simply buy and hold for the long run. If anything, some of the most catastrophic financial blow-ups in modern history were engineered by people with the most impressive resumes in the room. Here's the core problem. We've been taught to treat money like physics. Physics is elegant because it's governed by fixed laws. Drop an object, and gravity behaves exactly the same way every single time, regardless of who's watching, how they feel, or what mood the object happens to be in. Finance is often taught the same way. Plug your numbers into a formula, and out comes the mathematically optimal answer. Discount this cash flow. Diversify according to this ratio. Rebalance on this exact schedule. The problem is that money isn't physics. Money is attached to a person, and a person is not a rational, emotionless calculator. They're a walking bundle of fear, pride, envy, hope, and memory. A formula can tell you the mathematically correct amount of risk to take on paper. It cannot tell you what it will actually feel like to watch your life savings drop by 30% in a single month, or what you will really do at 3 in the morning when that happens. Knowing the right answer intellectually and being able to live with that answer emotionally are 2 completely different challenges, and only one of them gets taught in business school. You don't have to look far to find brilliant people who learned this the hard way. In the late 1990s, a hedge fund assembled what may have been the most academically credentialed investment team in history, including economists who had recently won the Nobel Prize for the very theories the fund was built on. Their models were dazzling. Their math was, by most accounts, essentially correct. And yet the fund still collapsed so violently that it threatened to destabilize the entire global financial system, because the models assumed markets would behave rationally, and markets full of frightened, irrational humans simply refused to cooperate. That's the trap of cold rationality. It's seductive because it feels rigorous, precise, and safe. But the mathematically optimal strategy on a spreadsheet is often not the strategy a real human being can actually stick with once markets turn ugly. And a good plan you abandon in a panic is worse than a mediocre plan you're able to follow for 30 years straight. You see a smaller version of this trap play out every single year among professional fund managers. Study after study has shown that the vast majority of actively managed funds, run by people with elite degrees and years of training, fail to beat a plain, unmanaged index fund over long stretches of time. It isn't because these managers lack intelligence. It's because the pressure to look clever, to justify their fees, to react to every headline, pushes them toward constant activity. They trade when a patient, unglamorous, do-nothing approach would have served their clients better. Intelligence gave them the tools to build complicated strategies. It did nothing to protect them from their own restlessness. This is why so many thoughtful investors have quietly shifted from chasing what's rational to chasing what's reasonable. Rational says, always take on more leverage if the expected return is higher. Always chase the theoretically optimal allocation. Never leave a single cent of value on the table. Reasonable says, take on the level of risk that lets you sleep at night, even if it isn't the mathematically perfect number, because the version of the plan you can actually follow for decades will always beat the perfect version you abandon after 18 months. This idea isn't just a nice turn of phrase. It's the entire premise behind the field of behavioral economics, which spent decades studying exactly why smart, well-informed people still make predictably irrational choices with money. The conclusion, again and again, was the same. Humans don't process financial decisions the way a calculator does. We weigh the pain of a loss far more heavily than the pleasure of an equivalent gain. We remember our best and worst financial moments far more vividly than our average ones. And we let those memories quietly steer decisions for years afterward. None of that shows up in a textbook formula, and none of it cares how many degrees you have. Picture two people with nearly identical portfolios. One follows the textbook optimal, heavily leveraged strategy. The other keeps a boring, unglamorous mix of solid investments plus enough of a safety cushion that a bad year never forces them to sell in a panic. On paper, in a simulation, the first strategy might win. In real life, across real decades filled with real recessions and real fear, the second investor is often the one still standing and still invested 30 years later. This is exactly what made Ronald Read so effective. Even without a shred of financial education, he never touched a spreadsheet. He never optimized anything. He simply picked reliable, unglamorous companies, avoided debt, lived well below his means, and left his shares alone for half a century, letting time and compounding do the kind of work that no amount of raw intelligence can rush. Reasonable and repeatable beats, brilliant and abandoned every single time. So if raw intelligence isn't the deciding factor, what is? It turns out the very same trait that makes brilliant people successful in other parts of life, supreme confidence in their own judgment, is often the exact thing that destroys them when it comes to money. Bill Gates once made an observation worth sitting with, that success can be a lousy teacher because it quietly convinces smart, capable people that they've become untouchable. Nobody demonstrates that danger better than Jesse Livermore, one of the most legendary stock traders of the early 20th century. Livermore had an almost supernatural read on market psychology. In October of 1929, while the stock market collapsed and wiped out the savings of millions of ordinary Americans, Livermore did the opposite of nearly everyone else. He bet against the market. When the crash hit, his short positions paid off spectacularly, reportedly earning him, in a single day, a sum worth well over $3 billion in today's money. He was, by any measure, one of the most successful traders alive, and then it went to his head. Flush with confidence bordering on invincibility, Livermore stopped respecting the same discipline that had made him rich in the first place. Earlier in his career, he had followed strict rules about when to cut a losing trade, how much of his capital to risk on any single bet, and when to simply stay out of the market altogether. After 1929, that discipline started to erode. He took on bigger, more reckless positions. He ignored warning signs he would once have caught instantly, telling himself that his instincts were simply too good to fail now. Over the years that followed, he lost fortune after fortune, was forced into bankruptcy more than once, and eventually, deep in debt and convinced his gift had abandoned him, he took his own life. The man who once out-traded the entire market couldn't survive his own certainty. Livermore isn't an isolated case. Centuries earlier, Isaac Newton, arguably the greatest scientific mind who ever lived, the man who defined the laws of motion and gravity, invested in a company at the center of one of history's most infamous stock bubbles. Newton sold early and locked in a solid profit. But as the stock kept climbing and everyone around him seemed to be getting richer by the week, he couldn't resist buying back in near the very top, at a much higher price, convinced his analytical brilliance would protect him. When the bubble finally burst, Newton lost a fortune and reportedly remarked afterward that he could calculate the motion of the planets, but not the madness of crowds. Two of the most capable minds of their respective eras, centuries apart, destroyed by the exact same disease. The belief that being right once meant they couldn't possibly be wrong again. This points to something the finance industry rarely says out loud. Getting money and keeping money are not the same skill, and they can actually work against each other. Getting money usually requires optimism, confidence, and a willingness to take risks that other people are too cautious to take. It rewards boldness. But keeping money requires almost the opposite temperament: humility, frugality, and a healthy dose of paranoia about how easily what you've built can be taken away. The same boldness that builds a fortune, left unchecked, is often exactly what destroys it. This is why so many people who make a great deal of money quickly also lose it quickly. Athletes who go from modest beginnings to multi-million-dollar contracts overnight. Lottery winners who are broke again within a few years. Entrepreneurs who ride one lucky bet to riches, then bet everything again on the next one. Certain their winning streak reflects pure skill, rather than a mixture of skill and luck. In every case, the recipe for getting the money, big risk, big confidence, big bets, is precisely the wrong recipe for keeping it. It also explains why formal education alone doesn't protect anyone. A finance degree teaches you how to build a discounted cash flow model. It doesn't teach you what to do with your emotions the first time your net worth drops by a number larger than your annual salary. Nobody hands out a diploma in staying calm. That skill is usually only earned the hard way, through experience, and often through a painful loss along the way. The investors who quietly stay wealthy for decades tend to look almost boring by comparison. They save a high percentage of what they earn, regardless of how much that is. They stay skeptical of their own hot streaks. They assume, correctly, that markets can and will occasionally do something that makes them look foolish, and they build in enough of a cushion that a bad surprise doesn't wipe them out. It isn't a thrilling strategy. It rarely makes headlines, but it survives, and survival is the only quality that actually compounds over a lifetime. So the swelled head isn't a character flaw limited to a few unlucky traders. It's a predictable trap for anyone who's ever been right often enough to start believing they can't be wrong. The very intelligence that got Livermore and Newton to the top was also what convinced each of them their judgment was now beyond question. And the market, which has never once cared about anyone's IQ, made them pay for that certainty in full. If humility and paranoia matter more than intelligence, why do so many smart investors still struggle? Because intelligent people are trained to solve problems by adding complexity, and investing is one of the rare fields where complexity is usually a liability, not an advantage. Give a brilliant analyst a portfolio, and their instinct is to improve it. Layer in a more sophisticated hedge, chase a marginally better tax structure, rotate into whatever sector the latest research suggests is undervalued. Many spend a genuinely staggering amount of time and energy grinding for an extra fraction of a percentage point of return, and sometimes, in a given year, that extra effort even pays off. But there's a much simpler, far less glamorous strategy sitting right next to all of that complexity, and it consistently wins over the long run. Some combination of frugality and paranoia. Spend meaningfully less than you earn. Keep enough of a cash cushion that you're never forced to sell your investments at the worst possible moment. Stay just a little bit afraid at all times that something unexpected could happen. Not because you're pessimistic, but because that low-grade paranoia is precisely what keeps you from getting wiped out by the one bad year that catches everyone else off guard. Here's the part that rarely gets said out loud. Your short-term paranoia and your long-term optimism aren't in conflict. They actually need each other. The paranoia is what keeps you alive and still invested through the crash. The optimism is what makes it worth staying invested in the first place, so that when the recovery eventually comes, as it historically always has, you're still there to benefit from it. Lose either half of that equation, and the whole strategy falls apart. Pure optimism without paranoia gets you wiped out in the first serious downturn. Pure paranoia without optimism keeps your money sitting in cash forever, quietly losing value. None of this requires any special talent. It requires almost the opposite of talent. A willingness to do something unremarkable, over and over for years, without needing it to feel impressive. Frugality doesn't win any admiration at a dinner party. Keeping 6 months of expenses in cash instead of chasing a slightly higher return doesn't make for an exciting story. But both of those unglamorous habits are precisely what allow an ordinary person to survive the one bad decade that would otherwise wipe out 30 years of progress. There are very few variables in investing that reliably predict how much money someone ends up with. But one of the strongest is remarkably unglamorous. Whether or not you kept contributing to your strategy during its worst, most miserable years, the years when the headlines are terrifying, when your portfolio is down, when it feels obvious to everyone around you that things are only going to get worse. Anything, no matter how boring, that keeps you invested and participating during those years carries a real, measurable advantage over strategies that are theoretically smarter, but that people actually abandon under pressure. Think about two investors who both start with identical portfolios. One panics and sells everything during a market crash, sits in cash through the recovery, gets nervous again during the next crisis, and repeats that same pattern during every downturn that follows. The other investor, with a far less sophisticated understanding of markets, simply keeps contributing on the same schedule through every single one of those crises, doing nothing clever at all. Across a couple of decades, the second investor, despite having no particular insight or brilliance, ends up dramatically wealthier than the first, not because their strategy was smarter, but because they were still in their seat when the recovery happened. This is the endurance advantage. It has nothing to do with finding the cleverest trade or the most sophisticated model. It has everything to do with your capacity to simply hold on, to shut up and wait, while everyone smarter than you is convinced they've found a shortcut. Think about it in terms of decades rather than days. An investor who earns a fairly ordinary average return every single year for 30 straight years will, thanks to compounding, end up with dramatically more money than an investor who earns a spectacular return in some years and a devastating loss in others, even if their average looks similar on paper. Consistency, not brilliance, is what compounding actually rewards, and consistency is entirely a behavioral trait. It has almost nothing to do with how many years of school you completed. Here's the uncomfortable truth. Your results as an investor will not be decided during the calm, uneventful years, when markets quietly drift upward and nothing much is required of you. They'll be decided in a handful of terrifying moments: the crash, the recession, the headline that makes your stomach drop, and how you respond in exactly those moments. There's an old idea about military leadership. That genius on the battlefield isn't about doing something extraordinary. It's about staying calm enough to do the ordinary, sensible thing at the exact moment when everyone else around you has lost their composure and is making decisions out of pure fear. The same logic applies almost perfectly to money. The investors who end up wealthy aren't usually the ones who found some brilliant trade nobody else saw. They're the ones who managed to do the boring, sensible thing. Keep contributing, stay diversified, avoid panic selling, while everyone around them was losing their mind. You need enough humility to admit you're not as rational as you think you are. Master your own psychology, and you will have an edge that no amount of raw intelligence could ever buy. Ronald Read never once tried to beat the market. He simply refused to be beaten by his own emotions. That, more than any formula, is the real starting point of building lasting wealth.